One part of this conversation is all about LNG, obviously, and then we are also looking at transportation fuel. Yesterday, ATF prices were raised. Petrol diesel prices in India have been raised continuously since the time that the so-called unlock one has happened. There's no relief for consumers, but also now when you look at the way that OPEC Plus is their strategy going forward. So what is in store for us?
You asked me two questions, which will probably take us on slightly different streams, but let me address the first one first, which is India. I do realize it's been a bit of a raw nerve. Of course, the press has been all over the fact that prices at the pump are much higher even than back in January, when crude prices were much higher than where they are today. I should have probably posed this question to Mr. Anand. But look, this is pretty much the situation globally, and something that is not as well understood, unfortunately, amongst people, consumers, is that the final price at the pump is made of different components, and the input costs in terms of crude feedstock, the refinery margin, transportation is only a part of it. Various duties and taxes are a big part. Now, it so happens that in India, that is a relatively bigger proportion of the final fuel price. And as probably our viewers know well, the Indian government raised taxes on diesel and petrol in the past few weeks. So as a result of which, that more than compensated for the drop in feedstock costs. Now, my personal view on this is, it is a complex matter. Basically, what it boils down to is that as a government, of course, and as policymakers, you need to decide whether you want to, what proportion of the advantage of lower international oil prices you want to pass on to the consumers. Now, and also it's a very economics-driven argument as well. The government is taking more of that advantage right now by increasing the taxes. So really what it means then is that the government is saying that we will put this money, or rather it's committing, or ought to commit to putting that money to better use than if it were to be left in the pockets of the consumers. That in the end, that's what it boils down to.
It's an interesting argument, but yes.
Yes, so perhaps we could talk for hours about this, but let's move on to OPEC. OPEC has played a very key role for the past 3 years, I would say. So again, our viewers will recall the price crash of 2014 to 2016. It was obviously not as bad as what we've seen this year. But nonetheless, it rattled a lot of producing countries. And, OPEC was in a dilemma, whether to continue cutting back and letting shale flourish as a result or not. And ultimately, they took that very difficult, controversial decision to regroup, in fact, with non-OPEC and to reduce supply. And we saw a very steady rise in prices from 2017 as a result of that. We saw a dramatic collapse of that OPEC, non-OPEC alliance in March this year, but they have again regrouped. So as things stand now, what COVID has done is, because of this unprecedented destruction of demand, and we, of course, we're getting out of that destruction, but it's still substantial demand that still remains disappeared, up to 10 million barrels per day, or 10% of global oil demand, even at this point of time, has not come back. What that has done is actually it has given a lot of power over prices and over market rebalancing to OPEC. And they have risen to the occasion, as I see it, cutting back 10 million barrels per day, nearly a quarter of production for every single participating member of the 23-member alliance. it wasn't a mean feat. They've also delivered amazingly well on that. There was a lot of skepticism that they would be able to comply with those kind of massive cuts, but they have managed to. And the combination of OPEC, non-OPEC cuts from the start of May and the easing of lockdowns and a slow revival of demand is basically these two factors have combined to push prices up from the start of May that we have seen.